Tomorrow could change everything, and I need you to understand exactly what's about to happen because the vast majority of people watching the markets right now have absolutely no idea what's coming. They think they do, they've read the headlines, they've seen the speculation, but they don't understand the mechanics. They don't understand the cascade that's about to be triggered, and that lack of understanding is going to cost them dearly. The Supreme Court is about to rule on Trump's tariffs. And according to the most reliable legal analysis available, there's a 76% probability that these tariffs will be ruled illegal, unconstitutional, void from the start. Now, when most people hear that, they think it's good news. They think, great, tariffs are bad for business, this is bullish for stocks, the market will rally. But they're wrong, dead wrong. And I'm going to explain exactly why. You need to look past the surface. You need to understand what happens the moment after that ruling comes down. Because that's where the real damage begins. That's where the chaos starts. And if you're not positioned correctly, if you're not prepared for what's coming, you're going to be caught in a financial shockwave that will rip through every asset class simultaneously. Let me walk you through this step by step, because the implications are staggering, and most analysts are completely missing it. First, let's establish what we're dealing with. Trump's tariffs have been in effect for a significant period. They've generated massive revenue for the Treasury. Hundreds of billions of dollars have been collected from importers, from businesses, from companies bringing goods into the United States. That money has been counted, it's been spent, it's been baked into budget projections and deficit calculations. The government has treated that revenue as permanent, as reliable, as money they can depend on. But if the Supreme Court rules these tariffs illegal, all of that changes in an instant. Because here's what nobody's talking about. Here's the ugly part that should terrify anyone holding risk assets right now. Trump himself has explicitly stated that the payback could be hundreds of billions of dollars. And that's just the direct refunds. That's just the raw tariff money that was collected and now has to be returned. But it gets worse, much worse. Because when you factor in investment damages, when you account for the business decisions that were made based on these tariffs, when you calculate the economic harm caused by policies that are now being declared illegal, that number doesn't stay in the hundreds of billions. It explodes into the trillions. Think about what this means. Companies restructured their entire supply chains because of these tariffs. They moved factories. They canceled contracts. They changed vendors. They made billion-dollar decisions based on a tariff regime that the Supreme Court is about to say never had legal authority to exist. And those companies will have grounds to sue for damages, massive damages, damages that could collectively reach into the trillions of dollars. Multinational corporations don't just absorb that kind of impact. When they face unexpected costs in the hundreds of millions or billions, they have legal teams that will pursue every avenue of recovery. And when the Supreme Court declares these tariffs unconstitutional, it opens the floodgates. It gives every affected company a clear legal path to demand compensation, not just for the tariffs they paid, but for the disruption to their business, the lost contracts, the stranded investments in new facilities, the opportunity costs of decisions made under a now invalidated policy framework. But even if we ignore the lawsuit avalanche that's coming, even if we just focus on the immediate impact, we're looking at a fiscal catastrophe. The moment the Supreme Court strikes down these tariffs, they instantly blow a massive revenue hole in the Treasury, money the government was counting on, money that was funding operations, money that was offsetting other expenditures. That money vanishes overnight. This is what I call a fiscal shock event. It's not a gradual adjustment. It's not a policy change that gets phased in over months or years. It's an immediate, violent rupture in government finances. One day the Treasury has this revenue stream, the next day it's gone. And not only is it gone, but they owe refunds, potentially hundreds of billions in refunds that have to be paid out immediately. Now, where does that money come from? The government doesn't have a rainy day fund sitting around. They don't have surplus cash to handle unexpected multi-billion-dollar obligations. There's only one option. They have to borrow. They have to issue emergency debt. They have to go to the bond market and say, we need hundreds of billions of dollars, and we need it now. And here's where this starts to affect you directly, even if you don't own a single government bond. Because when the Treasury floods the market with emergency debt issuance, when they dump that much supply into the system all at once, it doesn't happen in a vacuum. Bond yields spike, interest rates rise, credit conditions tighten, and every asset that's priced off those interest rates, which is basically everything, has to be revalued immediately. The math here is brutal. When bond yields rise, the present value of future cash flows falls. That's not opinion, that's mathematics. Every stock in your portfolio, every corporate bond, every piece of real estate, they all get repriced lower when the risk-free rate jumps. And we're not talking about a gradual 25 basis point move here. We're talking about a potential shock move of 50, 75, maybe even 100 basis points in a matter of days. But the market isn't pricing this in. That's the insane part. I'm watching the options market. I'm watching credit spreads. I'm watching volatility indices. And the market is not pricing in the chaos that's about to be unleashed. They're not pricing in the refund fights. They're not pricing in the emergency debt issuance. They're not pricing in the sudden retaliation risk. Because let's talk about retaliation for a moment. Trump has never been someone who takes losses quietly. If the Supreme Court invalidates his signature trade policy, if they force the government to pay out hundreds of billions or potentially trillions in refunds and damages, do you really think there's no response? Do you really think the administration just accepts that and moves on? Of course not. There will be retaliation. There will be new policies. There will be executive actions designed to accomplish through different means what the tariffs were supposed to accomplish. Maybe it's currency intervention. Maybe it's new regulatory barriers. Maybe it's sanctions or investment restrictions or capital controls. The exact mechanism doesn't matter. What matters is that when a government faces this kind of humiliation, this kind of financial loss, they respond. And that response creates more uncertainty, more volatility, more risk. And markets hate uncertainty more than they hate almost anything else. You can price in bad news if you know what the bad news is. But when you don't know what's coming next, when policy becomes unpredictable and erratic, capital freezes. Investment decisions get delayed, risk premiums expand, and asset prices fall. So now you have multiple fires burning at once. You have a fiscal emergency, you have a debt issuance shock, you have policy uncertainty, you have retaliation risk, and you have a market that's completely unprepared for any of it. A market that's actually positioned for the opposite scenario. A market that's long, leveraged, and exposed. When that reality hits, when traders and investors wake up and realize what's actually happening, liquidity will be pulled from everywhere at once. And I mean everywhere. This isn't a situation where money rotates from stocks into bonds, or from bonds into cash, or from one sector to another. This is a situation where everyone tries to get to the exits simultaneously. Bonds will be sold because yields are spiking, and prices are falling, and nobody wants to hold debt from a government facing a fiscal crisis. Stocks will be sold because rising rates destroy valuations, and uncertainty destroys confidence. Crypto will be sold because when people need immediate liquidity, when they need to cover margin calls or meet redemptions or just get to cash, they sell the most liquid assets first. And crypto, for all its philosophical benefits, for all the talk about digital gold and decentralization and independence from traditional finance, becomes exit liquidity in moments of panic. I've watched it happen before. When traditional markets crater, crypto doesn't stay insulated, it gets pulled down too, sometimes even harder, because the same people who own stocks and bonds also own Bitcoin and Ethereum. And when they get margin calls, when their risk limits get breached, they sell what they can sell quickly, they sell what's liquid 24/7, they sell crypto. The Forex markets will go haywire too, because if the US government suddenly faces a fiscal crisis, if they have to issue emergency debt and potentially face credit rating downgrades, what happens to the dollar? It weakens. And when the world's reserve currency starts weakening rapidly, that creates chaos in every corner of global finance. Emerging market currencies swing violently. Carry trades unwind. Central banks have to intervene. It becomes a self-reinforcing spiral of volatility. I've seen this pattern before. I've been doing macro analysis for over 20 years. I've traded through multiple market cycles. I've seen what happens when multiple negative catalysts converge at the same time. I've watched markets that looked calm and stable turn into absolute chaos within hours. The 1998 long-term capital management crisis, the 2008 financial meltdown, the 2020 COVID crash, they all had this same characteristic: multiple systems breaking at once, liquidity disappearing, and everyone scrambling for the exits. And I've called the last 3 major market tops and bottoms publicly. I didn't make those calls quietly or in hindsight. I put them out there for everyone to see. I told people when to get in and when to get out. And I was right. Not because I got lucky, not because I have some magic formula, but because I understand how these systems work. I understand the mechanics of market structure. I understand how liquidity flows and where the breaking points are. I understand that markets aren't just about fundamentals and valuations. They're about positioning. They're about sentiment. They're about the structure of who owns what and who's leveraged and where the forced sellers are. And right now, the positioning is terrible. The market is crowded on one side of the boat. Everyone's expecting the same outcome. And when everyone expects the same thing, when everyone's positioned the same way, that's when you get the most violent moves in the opposite direction. Right now, we are approaching one of those breaking points. Tomorrow's Supreme Court ruling could be the trigger that sets everything in motion. And the scary part is how few people see it coming. They're looking at the surface level narrative. They're thinking, tariffs bad, no tariffs good. But they're not thinking 3 steps ahead. They're not thinking about the second order effects and the third order effects and the cascading consequences that follow. Let me give you a concrete example of how this plays out. Let's say the ruling comes down tomorrow morning. The tariffs are struck down. Within hours, companies start filing for refunds. Within days, they start filing lawsuits for damages. The Treasury has to immediately revise its revenue projections. The deficit projections blow out. Credit rating agencies start making noise about potential downgrades. The bond market reacts first. Yields jump 50 basis points in a single session. Maybe more. Treasury auctions start to show weak demand. Foreign buyers, particularly China and Japan, start reducing their holdings. They've been looking for an excuse to diversify away from U.S. debt anyway, and this gives them the perfect justification. Stock market algorithms see rising yields and start selling. High-growth tech stocks, which are most sensitive to interest rates, get hammered. The Nasdaq drops 3% in the first hour, then 5% by midday. The S&P follows. Banks get hit because higher rates mean lower bond values, and they're sitting on huge bond portfolios. Regional banks, which are already under stress, face another crisis. The crypto market, which had been rallying on hopes of friendly regulation and institutional adoption, suddenly faces a risk-off environment. Bitcoin drops 10% in an hour. Altcoins drop 20, 30, 40%. Leveraged positions get liquidated. Exchanges struggle with the volume. Some smaller platforms halt withdrawals. But it doesn't stop there, because now you have hedge funds that were leveraged long. They're getting margin calls. They have to sell. They don't have a choice. It's not about their market view anymore. It's about meeting their obligations to their prime brokers, so they sell their best positions. The liquid stuff, the names that have been working, and that creates more downward pressure. Market makers pull back. They widen their spreads. They reduce their quote sizes. Liquidity dries up. What started as an orderly sell-off becomes a rout. Circuit breakers might get triggered. Trading halts on individual stocks. The VIX spikes to 40, 50, maybe 60. Fear becomes contagion. Contagion becomes panic. And here's the thing. Once this process starts, it's very hard to stop, because selling begets selling. Volatility begets more volatility. Fear feeds on itself. You get into what's called a reflexive loop, where the market action creates the reality that justifies more market action. The Federal Reserve might try to step in. They might issue statements. They might hint at emergency measures. But their credibility is already strained. They've been behind the curve on inflation. They've been inconsistent in their messaging. And frankly, there's only so much they can do when the problem is fiscal, not monetary. You can't print your way out of a Supreme Court ruling. You can't cut interest rates to fix a massive revenue hole in the Treasury. This is why I'm telling you to be careful out there. This is why I'm sounding the alarm right now, before it happens. So you have time to think about your positioning. So you have time to reduce risk if that's appropriate for your situation. So you're not caught completely off guard when this hits. I'll be sharing my next move very soon. I'm watching this situation extremely closely. I'm monitoring every data point, every market signal, every legal development. And when I make my decision, when I decide to either take defensive action or position for the chaos, I'll share it publicly. But you need to be following me to see that. You need to have notifications turned on, because this will move fast. If you haven't followed me yet, you're going to regret it. I don't say that to be arrogant. I say it because I've been right before. Consistently. And the people who ignored those warnings paid the price. The people who waited too long, who thought they had more time, who assumed it wouldn't be that bad. They lost money. A lot of money. I was able to make my first $1 million by the time I was 26 years old. Not because I got lucky, not because I had rich parents or inside information, but because I learned to read markets. I learned to see what others miss. I learned to position ahead of major moves instead of reacting to them after they happen. And I've put everything I learned into a comprehensive guide. A step-by-step roadmap that shows exactly how I did it. The mindset, the strategies, the specific tactics that allowed me to build real wealth while others were still figuring out the basics. If you want that guide, if you want to learn how to navigate markets like this, comment the word million right now and check your DMs. I'll send it to you directly. But whether you get the guide or not, please take this warning seriously. Tomorrow could be the worst day of 2026 for financial markets. The Supreme Court ruling on Trump's tariffs could trigger a fiscal shock event that cascades through every asset class. Bonds, stocks, crypto, forex, everything could be hit simultaneously, and the market is not prepared. The positioning is wrong. The complacency is dangerous. Be careful out there. Protect yourself. Think about your exposure. Think about what happens if I'm right, because I've been right before. And I'm putting my reputation on the line again to warn you about this. The storm is coming. The question is whether you'll be ready when it hits.